If you have to take a lot of risk to achieve performance, you might be taking risk that's really correlated with other parts of your portfolio.
Welcome back to the issue at hand. I'm joined again by Mike Sanders. How you doing, Mike?
Doing good.
So before we get started today, I wanted to quickly recap the first two topics that we've covered in the issue at hand. And of course, I encourage you to go back and always listen to those episodes. So first, what we covered were the major risks of fixed income and how you and your clients should have those conversations, what you should be looking for. The second episode, we covered active versus passive, that great debate, how they differ on the types of risks and what considerations you and your clients should kind of work through when evaluating what is best for them. So now let's transition to what we're going to talk about today. Today, we're going to cover how do you evaluate that manager? How do you quantify? What do you look at when you're looking at an active manager? So what we're going to do today is, Mike's going to help me cover this, is we're going to cover the risk and return metrics, and hopefully we're going to come up with a step-by-step process for understanding why a bond manager performed the way that they did. So Mike, I guess with that backdrop, how about you set up the first topic?
Yeah, so, I think it just comes back to risk management. I think to be a good investor, I think you have to be a good risk manager. I think they go hand in hand. And what we really kind of want to show in this episode or discuss is how, managing risk can translate into performance, and then how there's specific statistics that one can look at that allows you to assess the risk management and the performance, and why just looking at performance alone maybe doesn't tell the whole story when you're kind of evaluating what type of manager you want to use.
Well, I think you kind of threw it in the good one is when you're not just looking at performance. So I think what that means is, or at least how I'm interpreting it, is we should dig into the why. How did the manager, generate this alpha? Are they using, low quality credit? Are they using derivatives? What are some of the things that we should be looking for then?
Yeah, there's a lot of different ways that a manager can generate performance, like you said, high yield allocations, duration management, derivatives. There's a lot of levers a manager can pull, those fixed income risks that we discussed. And again, each one of those securities or asset classes kind of has their own risks in a way. And then that translates into all of those and generate that performance, and then translates into all those statistics that we want to discuss, right? Volatility, alpha, tracking year, inflation ratio, all of that is derived based on the risks these managers want to take. And I think, again, the overarching decision from an investor's perspective is the risks that the manager is taking in your fixed income portfolio. How is that relating to risks you're taking in other places in your asset allocation? I think it has to go hand in hand you're evaluating what kind of a manager you want to use.
All right, well, then let's dig in. A couple of things that you just mentioned in there, I think that we need to explain to people, and one of the ones that I want to focus on is going to be information ratio. I want to talk about tracking error. And then I think we need to also touch on in the past episode, we talked about the differences in the benchmarks between equity benchmarks and fixed income benchmarks, and I relate that to how people think about beta. So let's start there on beta. How should advisors be talking to their clients about beta when it comes to fixed income portfolios?
The easiest way to think about beta in the construct of a fixed income portfolio is to think about an entire corporate bond portfolio. In theory, or in reality, a lower quality or high yield, when spreads are tightening or the market's doing well, will move a lot better than what maybe an A-rated or double A-rated corporate bond would be. So in theory, they have more beta. It's the same concept as a more volatile, or maybe a little more volatile stock versus the rest of the market in broad terms. And so when you think about taking on beta risk, and a way to think about it in fixed income is maybe allocation to lower quality credit versus the overall corporate bond market, or you could relate that to maybe mortgages or other securitized product as well. That's the best way to kind of think about
that makes sense.
Perspective beta.
I think it's just, again, when we're talking about exposure to the market, we need to know, are we going on the lower credit quality side, or are we going on the higher credit? That makes sense.
Correct.
I guess
Yeah.
I don't want to get in the weeds too much, because the one I do want to focus on, what I think most active managers kind of focus on, is information ratio. So can you touch on what that is and how clients should be, I guess, looking at that?
Yeah, I think and from our perspective, I really do think that's one of the more important ones to focus on. It really is a way to describe or view the amount of excess return a manager is achieving, which again is the goal of active management, is to outperform whatever benchmark you're against, but also to measure that against how much risk you've taken to outperform that benchmark. So, you generate 100 basis points a year in excess return or alpha, but there's obviously a risk associated with that excess return, and information ratio kind of balances those two numbers out to give you a statistic that says, well, for per unit of alpha, every basis point of alpha, it costs you this much in risk.
I mean, I understand that, but I think if I want to break it down, give me the formula. Essentially, it is, what is your active return over your active risk, right? How
Correct.
my return is to the benchmark versus what the risk is that I'm taking with regard to the benchmark. Is that fair?
Correct. Yeah. I mean, if you put numbers into it, if it's 100 basis points of alpha, but you took 50 basis points of active risk, you'd have an information ratio of 2. And that's how to think about it.
And I guess when we're looking at this as a skill or something that we should be looking at, this is just yet another tool that a client or a financial advisor should be utilizing to evaluate managers in their portfolios, right?
Correct. Because again, generating excess return and alpha is doable when you take a lot of risk. But if you have to take a lot of risk to achieve performance, you might be taking risk that's really correlated with other parts of your portfolio. And so that's why I think it really does matter. Information ratio is a one singular number, but you do have to go a little bit deeper in thinking about what the manager owns or how they manage those four risks in fixed income. And it's a combination of everything. Again, just looking at alpha, can get in trouble by doing that. If you just look at information ratio, you can get in trouble by looking at that. I think it's really a combination of looking at everything and seeing how the process that a manager uses to generate performance relates to an overall asset allocation.
No, that makes sense. I mean, at the end of the day, it's not going to be one thing solves everything. You need to have a combination of things. Now, if I'm a client, and now I kind of want to break it down to how do I want to evaluate manager A versus manager B? Let's try and put terms on this. So if I have manager A is generating high returns one year, negative returns the next year, but has an information ratio of about 0.1 versus a manager not as high up, not as low down, but has an information ratio of 0.5, how should I go about evaluating manager A versus manager B?
Well, again, there's no right or wrong answer for this, right? If an investor is comfortable with maybe more expected excess returns, but having more volatility, that's fine. If they want more consistency, that's another decision to make. Going back to it being a good or bad number, I mean, you think about, private credit and firms being able to mark to market their own portfolio, which dampens their volatility. So you have better performance and an artificially high information ratio if they quote that number because they're marking to mark. There's less trading. That's a way that you could have a really high information ratio, and it's not really a true representation of manager skill or amount of risk that they're taking. So again, it's how you value alpha in terms of your overall asset allocation, what your goal is, what you're trying to achieve.
Well, I think you just also made a great point is when we're looking at information ratio, yes, you want to go with the higher information ratio, but you also need to understand how was that information ratio achieved. I think that's a nice point to put. I want to use maybe some real world examples. So if I'm still in this phrase of manager A versus manager B, how would they do in 2008? How would they do, I guess, 2022 when rates started to come up? How should we evaluate those two managers during those periods?
Yeah, I mean, I think looking at if you were truly trying to assess the two different managers, looking at periods of volatility and seeing how the manager's up down capture ratio would be a great way to do that. Performance in good markets, performance in bad markets. Those are other levers that you can pull in terms of assessing a manager's performance. Most likely, higher information or lower information ratio when volatility hits the standard deviation of their alpha probably widens significantly. It could be down a lot versus a benchmark.
Yep.
Versus the higher information ratio, most likely, not all the times, but would probably have a much tighter performance pattern versus the benchmark. So I think that's, again, it's not a broad statement, but in general, these are maybe the ways to think about that. But again, other ways to look at manager performance. And I think really the key is to make sure you understand how they're generating that performance, and are you comfortable with the generating of the performance, and then how that relates to the actual performance statistics and the different ways that you measure it.
Well, that's a good point. I think so. Let's just put a ribbon on that. I think what you're saying is some of the questions that we should be asking is, where did the performance come from? What risk generated that performance? Is there consistency to that performance? Like, are we looking at long periods of time? Is it short term? How does that manager perform in difficult markets? And then I guess, does the manager's strategy, does the manager's views align with what's going on with my client's risk tolerance? I think those are some of the things that when I'm listening to you talk, I think that's the framework that people should walk away from. What do you think?
Yeah, 100%.
Okay. Well, I think it's a great place to end. I think we've covered enough things. So for more information and disclosures, please visit MadisonInvestments.com. If you haven't already, please subscribe to The Issue at Hand. You can find us at YouTube. You can find us on Spotify, Apple Podcasts. And thank you for tuning in. Take care.